Hey everyone, hope you're doing well. This is the Deep Dive, and my name is Drew Creekmur. I'm a wealth advisor here at Creekmur Wealth, and I'm joined by John Creekmur, our senior wealth advisor and founder. And today we're going to talk about the current earnings season that's going on, recap some critical sectors for the economy, how those companies are doing with their past quarter's earnings, and really talk about what that means broadly for the economy at large and market. But before we do that, John, how are you doing today?
Doing great, and I think probably the theme phrase is going to be "Show me the money." Is the way things we're going to talk about today, and just a reminder. People always say, "Well, why does the stock market go up? Why does it go
Right.
down?" At the end of the day, it's really about our companies making money, and then what is the prospects to make money here in the near future. And so, right now, we're at the end of earnings season here, at the end of the first quarter, and so. A lot of companies are being told, "Hey, show me the money. What did you do on sales? What did you do as far as in earnings? And then how are things forecasting out?" Especially when there is so much like a death knell in the economy. Hey,
Yeah.
we're going to this deep dark recession, and so everyone's going to be losing money and left and right, and we'll just kind of see how things are playing out. So I think that really is the biggie right now. They're trying to actually see where the economy's at.
Yeah.
Those are the big questions to go for.
Yep, and we'll definitely hit on that. And I think, John, this is a kind of a natural point to bring this up. We are having a large event in Central Illinois. So if you live in the area, you can attend in person. If you don't, you can register to live stream this online. The event is called True Wealth Live. And we have a great speaker coming in to talk about, honestly, a lot of the things we're going to talk about today in much greater detail than what we're going to be able to go into here. So, John, can you kind of just recap for everyone what True Wealth Live is and why we're so excited about this event?
Yeah, True Health Live really was kind of born out of the whole COVID season. So remember back in 2020 and 2021, there was so much information being put out, but it was conflicting information. You can listen to four different newscasts and get four different pieces of information, and you're not quite sure what in the world is the real truth on this. And I just heard from so many folks saying, "Man, we got to make decisions about our health, but decisions about our finances, decisions about retirement, and I don't even know what the truth is."
Yeah.
And so it's like, hey, let's just have an event to where we're going to have facts presented so people can be in a better position to be informed to make wise decisions. And so we took that and we created the truth live. And so it's an event that we have once a year, and we bring in a speaker that is known for really presenting facts. They're not going to be swayed by partisan politics or with just presenting things through just a separate lens. And so we have Bob Carey coming in from First Trust Portfolios. He is their chief strategist. So it's a pretty big name, high level presenter. Does a phenomenal job. He's actually shaped a lot of the personal financial decisions that Stacy and I have made over the last decade. And so we're so pleased to have Bob come in and speak. It'll be Tuesday evening, May 2nd, 7 p.m. If you're in Central Illinois, it's a pretty packed out venue right now. We do have some seats available. And so make sure you get registered. You can swing over at starting at 7 o'clock. If you're not in Central Illinois, we have people that watch our deep dive all around the country. Folks from actually different parts of the world that watch our deep dive podcast. And so if you're in different parts of the world, we're actually streaming this live on our YouTube channel at 7 p.m. There is a separate key code to get in there, so you want to make sure you register for that. Just send an email over or hit the link in the email that we received from this, and we'll get you the key code. But it's something with a lot of good information. You don't want to miss it.
Yeah, absolutely. It's a great opportunity to see a great speaker. The team over at First Trust, actually just saw this yesterday. They were named the top forecasting team for 2022 of all of the asset management, wealth management firms here in the United States. And so it's a great opportunity for you to see a world-class speaker come in and provide some fantastic information. So definitely give us a call or register using the link in this email. We'd love to see y'all. John, let's hop into it. We got a ton of ground to cover here. I really want to start with the group that reported first and is kind of seen as a bellwether for the economy, especially during periods of choppy economic data, and that's the banks. And we saw some really interesting things happen the last few months with banks here in the U.S. and over in Europe failing. And so a lot of people were hyper-focused on how would the big banks report. And high level, the big banks like JP Morgan or Citi or Bank of America, they reported record revenue. They had a very good quarter. in large part because they were able to take advantage of higher interest rates and deposits over at the Federal Reserve to earn a much larger percentage of interest income than what they typically do. But it was pretty interesting to see the big banks doing well. Now, while we still have some concerns about some more regional banks, whether they're going to be able to continue to go or not. So, John, when we think about the big bank earnings, what should we kind of key in on here?
Yeah, so big question is going to be how are the banks going to do with this huge switch as far as in interest rates jacking up at the end of last year? And what we saw is that across the board, the banks managed actually very well. Now, there were a couple outliers, and so we had Sovereign as far as bank up in New York. We have Republic out in San Francisco, and then we have Silicon Valley Bank over in California. Those were really localized. They were regional banks. A couple were kind of good size, though. However, they had a high level of internal risk issues that management just did not manage well. FDIC came out a report even this morning on Silicon Valley Bank, really just blasting management for the inordinate amount of risk they took in their portfolios. And so the risk was actually not in the loans they were putting out. The risk had to do with how they were managing the bond portion of their portfolio and going too long in maturity. And so, when we look across the board, though, everybody from JP Morgan to Citigroup to Wells, we're talking huge profits this year on trading in the first quarter, on interest sweeps, and also as far as on just the arbitrage inside their interest portfolios between what they're earning on deposits and what they're paying out as far as what they're earning on loans and paying out in deposits. And so large amounts of profits there we're seeing in the large banks across the board. A number of them actually talked about increasing dividends here in the second quarter. And so we're seeing tremendous opportunity there.
And John, one of the biggest questions we've gotten with some of these banks having issues through poor management is, are we going to see a 2008, 2009 type crisis here in the banking sector? And I know I have a pretty standard answer that I give people, but what would you say to that question?
Yeah, so this is totally different. And so 2008, 2010, and that financial crisis, the reality is that was created by the whole real estate crisis we had as far as with valuations being too high, people being too highly leveraged, and quite honestly, programs from the federal government that actually incentivize banks to give out loans to folks that really could not repay those loans. Which was actually something called a no documentation loan
Yeah.
to where you could just say you made X number of dollars with no documentation of your income and no documentation of your assets and be approved for a loan. Well, things have been tightened up quite a bit as far as in the banking side. So right now we don't see the risk anyway close to what it was in 08 to 010. And so these are two totally different situations, and really contagion at this point is not something to be concerned about. We don't see that risk being inherent within the system.
Yeah. Definitely. All right. Well, let's kind of transition over and talk about big tech. Big tech makes up a huge percentage of the market indexes. I believe the top 6 companies in the S&P 500 make up something like 28 to 30% of the index and make up 50% of the NASDAQ. So this is a huge focus for all investors looking at big tech. And big tech is Microsoft, it's Apple, it's Amazon, Google, Facebook. These are the companies that really tell us where the economy is going. And in the last, I'd say probably 2-3 quarters, these companies have been doing layoffs because they overhired during COVID. They've had some very negative earnings in the past couple of quarters, which has affected their stock price in 2022. This quarter, though, we saw some residual positive things begin to flow through from all the changes they made in their business in the last year. And so, John, what are we watching with big tech, and how do we kind of translate that out broadly to the economy at large?
I'd say the main takeaway from technology is really a right sizing. Is kind of what we've kind of gone through, and really during the entire COVID season, it was such a shock overall to the entire economy, specifically in technology. And so a lot of companies actually had to ramp up, and then they had to go in to say, "Hey, we got too big as far as on the HR side. We need to kind of make some adjustments." But also the world changed, quite honestly, as far as demand and technology. And so we saw greater advances as far as in technology. And so right now, demand is still very high. Everything from cloud computing to artificial intelligence to processing speeds as far as need within semiconductors. And so we're seeing across the board huge demand. And that's actually translated the cost cutting and also the huge demand into pretty much every single big tech name, whether it be NVIDIA On the chip side, AMD, we have Microsoft, we've got Google, we have Facebook, Meta. Those all actually outperformed expectations as it relates to their revenue side and also the earnings side. And we've seen some significant one-day pops in a number of those underlying stock prices of those companies. And quite honestly, they're actually bouncing back off of some really artificial lows oversold last year. The question is, does the stock price get further ahead as far as on the valuation of the company? But
Yeah.
right now, the earnings look very positive in big tech.
Yeah, and big tech looks positive. Now, underneath the hood, though, in the technology sector, some of the smaller companies, say a Pinterest or a Snapchat, their earnings were not quite as positive. And so, whether it's the banks, the big banks like JP Morgan or Bank of America, or the big technology companies, it seems like the big companies continue to do well, whereas some of the smaller folks are kind of treading water, trying to hold their head above water. Is that kind of like a fair summary of what we've seen so far this quarter?
Yeah, it really is. And so the smaller firms still have issues. And some of them have issues in their business models. A lot of the smaller companies, they have issues in their internal capitalization as far as with their balance sheets. And a lot of them actually were surviving based upon debt. Their growth was fueled upon debt. And when interest rates of debt go up, private equity companies, they have a higher demand as far as on return. And so you see a tale of two signs really based upon model. The big technology companies are extremely solid. And Drew, we have a lot of clients over the last couple of years have gone into our growth stock model. And that's something we've not talked about in a lot of detail, but that's 10 names and they're large technology names. And so 5 of them are the Google, the Microsoft, NVIDIA, larger names that people are aware of. But there's also some other growth names in there, larger companies that have phenomenal balance sheets. A Snowflake, a DDOG, a Viva in the medical technology space that are really propelling growth. And folks, if that's something of interest, we encourage you to reach out to your advisor and chat with them about that growth model. 10 to 12 individual stocks that we think are just ripe even for future development.
Yeah. And so I think, John, this is a natural transition point. We've talked about, hey, the big keep doing well. The big maybe are going to get bigger. Some of the small and mid-sized companies are maybe struggling a little bit. I think a lot of people would naturally then say, well, hey, what does that mean for my investments? How should I be trying to navigate these waters? Because I know we've talked about there's a lot of kind of interesting, weird things going on right now. So how are we talking to clients about walking through what is a lot of uncertainty right now in the markets?
Yeah, the midst of uncertainty, over time, I've been working with people as far as on managing their investment portfolio since 1991. So I've gone through a lot of different economic times, economic cycles. But I'll just put it this way: a lot of uncertainty over the last 30 years. And oftentimes, I see that we, as a consumers or as investors, a lot of times we get kind of whipped around on our investment decisions based upon emotion. And I know, Drew, one of your areas of study and interest is really the psychology of human behavior as it relates to their economy or to their personal financial decisions. Whenever you have uncertainty, kind of a natural position is I want to go and protect assets. That may not be the best decision. We also saw that a lot of times people they resort to what is called their most recent experience. It's called a recency bias. And so it's whatever your most recent experiences is. And so let's say the markets are moving up in the last year. Well, then we see people taking on a larger amount of risk probably than what they need to be. Or if the markets actually decrease or crash, then they have a higher propensity for a higher level of safety than what they probably need. And if we think about 2022 with interest rates going up, we saw the markets decrease. The S&P 500 about 19, a little over 19%. Nasdaq dropped about 35%. So if that's the most recent year, and you see your statement, a lot of people may go to a recency bias, and they might actually sell out of risk or growth investments because they don't want to experience that again. The reality is the psychology actually is pushing people, just with greater society, to a bad decision. And so
Yeah.
then they miss out as far as on the bounce back. And so I would say, first of all, Drew, everyone needs to make sure they understand their goal objectives and their time frames. What is it you're going to need to access funds, and what is the main goal for those dollars? And then let's say you need money in 12 months to buy a new vehicle. Well, then you have a different appetite for risk than if you don't need to touch the money for 30 years down the road or 10 years down the road. And then secondarily, you want to make sure that you align your investments and the level of risk that you're taking with those goal objectives and time horizons. So, Drew, that will help people navigate the uncertainty. And those are things that we encourage you. Don't go it alone. Talk with your advisor about those things.
Yeah, definitely. You know, what we want to avoid, we've talked about the market cycle of emotions in the past, but really what we want to avoid is selling low and buying back in high after the market's recovered. And that's where having a great dialogue with your advisor is really important. And, you know, John, we've worked really hard over the last probably 2 years to expand our toolbox to help people, no matter what the time is, to have the tools available to say, hey, the market's up. We're still going to be able to participate in some or all of that upside. But, you know, if the market's down, we're going to have protection to the downside. And so we have a ton of tools out there. If you have concerns or you want to make sure that you're positioned correctly for your current stage of life, definitely reach out to your advisor. So, John, let's wrap it up here. One last thing for everyone on our way out.
I'll tell you what, we always want to be really that deep well of truth and information so people will know as far as what the real facts are. And so whether it be True Wealth Live as far as on a nice and incredible program, or whether it be the video broadcast or talking to your advisors, just rest assured that you have true information coming to you to help you become more knowledgeable so be in a better position to make wise decisions.
Yeah, absolutely love that. If you guys want to attend True Wealth Live, click the link here in this email, register. We'd love to see you or give our office a call. Otherwise, we look forward to the next time we chat with you. Have a good one.